Welcome to Trading Nation. We are joined by Tony Dwyer, Canaccord's Chief Market Strategist. Welcome, Tony. First off, earlier on Trading Nation, a couple of days ago, David Rosenberg of Gluskin Sheff was on. He warned us about the disconnect that he sees between stocks and bonds. Listen to what he had to say.
I think the bond market is just basically responding to an economy that isn't really showing a whole lot of verve, if anything, disappointing, and inflation data that's coming in on the low side. So I don't think the bond market's telling you an inconsistent story here. I think if you believe what the stock market's telling you, the stock market is telling you that we're going to have a pickup in growth, reacceleration alongside pricing power throughout most of the economy. And I think that really is going to be the part of the story that is got a low odds scenario attached to it as far as I'm concerned.
All right, Tony, your response.
Well, you know, I'm hesitant. While I respect David quite a bit, I'm very hesitant to say that the bond market is quote unquote telling me something. And the reason I say that is the last time it was telling you something was at 362. It was telling you that yields were going to go to 3% and the economy was running too hot. Obviously, that was telling you nothing because it did the opposite. So now with the Citigroup Economic Surprise Index down here, well below minus 50, when that's happened outside of 2011 when you were in a European debt crisis and facing a fiscal cliff, outside of that period, that's indicated a low in yields. So we're suggesting that the drop in the long end could be stimulative. You should actually get a pickup in economic activity, which favors the more cyclical trades going forward. And I think that's also supported by the yield curve, which, you know, there's this narrative out there, Brian, that the yield curve flattening is, you know, telling you that the economy is closer to recession and that the stock market is in trouble. The history shows the opposite is true.
So, okay, so you respectfully disagree. That's what makes a market here. It's a really interesting chart. So when you extrapolate that out a little bit more, are you saying that right now, with everything going on, the market is still a good buy?
I think it's a terrific buy. You know, ultimately,
you're not worried about oil. Is oil sort of this wild card that's really fallen the last couple of weeks?
There's things that cause correction, but for a sustainable and significant drop, I mean, you can correct very easily. We frankly think you're going to get one very near term. But, you know, for a significant and sustainable drop, you really have to have a recession. And we are so not close to a recession. And what that chart shows you is from the when so many people talk about the flattening of the yield curve, when you look at the 6-month to 10-year spread, in the last two cycles, when it initially hit plus 100 from a higher level, the market went up significantly and sustainably over the next 2.5. You didn't have a recession for 2.5 or a bull market peak for 2.5 years, and that came before a recession. So you had your worst case scenario was a 34% gain, and that was in the last cycle from when you hit this level of spread until the bull market peak, 1995 to 2000, obviously more.
There's got to be something out there to worry about. We know you're bullish. We know you're positive. I don't want you to undermine your own thesis, but your job is also being paid to worry and to watch for things. Well, what does worry you a little bit?
Well, what would worry me here, Brian, is if you don't get a pickup in economic activity and the long end of the curve drops well below 2%, because that brings you closer to an inversion. Ultimately, what I was trying to say earlier and didn't do so well was the market correlates to the direction of earnings. The direction of earnings is driven by economic activity. That's driven by the slope of the yield curve and availability of money, driven by Fed policy, and driven by core inflation. Until those things go sideways, because that's what creates a recession, an inversion of the yield curve. This cycle, more than any other cycle, has proven that. We've had everything: European debt crisis every year, emerging economy crisis with commodities in 2015-16. We've had Brexit, Frexit, Italy. We've had Trump. Okay, no recession because the curve hasn't been inverted and the credit market has remained open. So with that said, anything, and think of how long we've been doing this together, Brian.
Long time.
Outside of recession, has it ever paid to sell weakness in the equity market?
No, it hasn't. Well, maybe, yeah, except for the 2008 period.
For maybe, and it's Trader Nation, so
yeah, but basically in the last decade, it is not. Basically, in the last decade, it is not. Tony, we got to let you go just because our satellite window is about ready to shut off. We'll get you back on though again soon.
Sounds like a plan.
Okay,
Thanks,
bullish
Brian.
Tony Dwyer says, hey, that's flattening yield curve could be a good time to buy. Thanks for watching Trading Nation, everybody. I'm Brian Sullivan. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.